this exclusive conversation with Mr. Suyash Choudhary, Head Fixed Income, IDFC Asset Management Company, on the debt market outlook. The central banks across the globe are raising interest rates, as we all know, owing to much higher than expected inflation. India is no different. RBI, in its recent policy, the May and the June policy, raised benchmark rates by 40 and 50 bips respectively, and the bond yields rose to their highest levels in 3 years. In the current scenario, how will the bond market play out, and what should fixed income investors do as this uncertainty continues? To talk on this and much more, joining me now is Mr. Suyash Choudhary from IDFC AMC. Welcome, Suyash.
Thank you so much. Pleasure to be here.
Suyash, we all know that inflation is the biggest worry for all the central banks, globally, and India, little bit better placed among the developed and emerging economies, but RBI is front loading, and we saw interest rate going higher. What is your take on the latest RBI monetary policy action, and what is your expectation in terms of interest rate trajectory going forward?
So, one of the very notable things about this global rate hike cycle is that market expectation with respect to this cycle is that it's going to be fairly aggressive, and B, that it's taking place in what is now a decidedly slowing world. So if you take, for example, the case of the US, after the last CPI print that came through, which was considered a shocker, markets are expecting something like 300 basis points of rate hikes over 5 Fed meetings in an environment where US consumer confidence has crashed to multi-decades low. If you look across at Eurozone, the situation is not very different. Europe hardly managed to hike interest rates in the last cycle once or twice before they had to reverse it. However, in this cycle, for some reason, markets expect that Europe will be able to hike by roughly 200 basis points by mid of next year. And again, similar problems there: consumer business confidence cratering, and economic prognosis is turning quite bleak. If you want confirmation, look at metal prices, fallen off very, very sharply over the last 2 to 3 months. Credit spreads globally are beginning to widen. So classic telltale signs that world is worried about growth. The latest one to basically fit there was a massive flattening to mild inversion on the US yield curve as well. Now, if you think about specifically the US market, you could argue that over the last 2.5 years, they have had almost an irresponsibly large fiscal and monetary stimulus, because of which the inflation problem that they're facing currently is not just to do with the Ukraine-Russia induced supply shock or supply chain congestions, but also has a significant component of demand in it. Now, how soon that demand element fades, we will see. But as of now, those central banks, US, also Europe, you could argue even UK or Australia, are now scared enough that they don't care about the slowing growth cycle. They are just going to hike into this, which obviously paints a very, very challenging backdrop as far as India is concerned as well. However, it is of use to see how the last 2.5 years went for India. So as compared to some of these developed markets, both our monetary and fiscal stimulus have been reasonably measured. Not just that, if you were to look at RBI has also commenced on a rapid normalization cycle somewhere starting October, November of last year. So not only was RBI's balance sheet expansion much more modest as compared to the US or Europe, but roughly 5% of reduction in balance sheet has already happened since October of last year. Secondly, the rate normalization cycle is very much in play. An effective hike, if you consider 3.35% as the starting point, we have covered significant distance of the order of, something like 130 basis point already. And the market fully expects that over the next few months, the RBI will be hiking more. So in India, obviously, there is a huge reset to inflation trajectory owing to what's been going on. But RBI's own assessment in the policy just gone by was that, so they have hiked their inflation forecast by 100 basis points from 5.7 to 6.7 for the financial year that is underway. But they are saying 70-75% of this is purely on account of global factors which are impacting food. So the characterization in some sense remains that a large part of this inflation is supply side. And because we were not irresponsible over the last 2.5 years, there is not a very large element of demand that RBI needs to stamp out. And therefore, respecting global factors as well as our own supply side inflation, RBI will have to continue to normalize policy. But unlike many other in the market, although we think that the process of normalization will proceed at a rapid pace, we don't think the RBI will actually continue to hike rates once they think a sort of neutrality has been achieved. So we think somewhere below 6% on the overnight rate is where this cycle will peak out, which is quite different from what the general perception in the market is, that RBI will probably continue to hike beyond 6% as well. So that is not our view at all. So, therefore, even though there is a lot of near-term volatility in the markets, we expect over the course of the next 6 months, as growth worries, continue to climb, and as some of the relatively optimistic assessment that we have with respect to domestic growth right now begins to unfortunately fade, we would also be able to cite a peak to the current rate hike cycle.
So which part of the yield curve offers an attractive opportunity to the investors? Is there merit in waiting for a few more rate hikes, or can one look at investing today itself?
So that's a very good question. One has to take into account two factors. One is, it's not really the rate hike that matters as much as whether the rate hike is in excess of what you were expecting, or it's in line with what you were expecting. So a very good example of that is the policy that happened in June, where even though there was a 50 basis point repo rate hike, bond yields actually fell on that day. That's because versus what market was expecting, the RBI did not surprise negatively. So that's the first thing investors need to keep in mind, because we hear a lot of commentary generally that RBI is hiking interest rates and therefore nothing makes sense on the bond curve, which is not something that we agree with. What again matters is versus what market is expecting, will RBI over deliver, under deliver, or deliver as per expectation? Like I said before, the market expects the RBI to be hiking all the way till 6.5 to 6.75. Our own expectation is that this rate cycle will peak out at below 6%. And a large part of what we are thinking comes from, like I mentioned, what happened over the last 2.5 years in India as policy response, as well as the fabric of growth right now, which is speedily slowing. The second thing to keep in mind is that a lot of investment advice today is probably assuming a flat yield curve. We don't have a flat yield curve. And to put that simply, a steep yield curve like what we have today means that the price of money at various tenure points is very different. So as an example, a 1-year treasury bill today is roughly around 6.1%. A 4-year government bond is roughly around 7.25%. And a 10-year government bond roughly is at 7.6%. So you can very easily see that between 1 and 4 year, there is a spread of something like 115 basis points. But between 4 and 10 year, there is a spread of hardly 35 basis points. So this throws up two action points in turn. The first action point is that you are basically investing today for carry and roll down. You don't really expect too much of mark-to-market gains. And therefore, positioning yourself at the 10-year point in our view is probably taking too much duration risk, given that 4 to 10 year spread is only 35 basis points. So you don't pick up too much of extra yield, but you actually pick up a lot of duration risk by choosing to be at 10 year and not choosing to be at the 4-year, 5-year. The second action point is that because the curve is so steep, even between overnight to 5-year, the cost of waiting is also pretty high. So one assumes that when you're waiting in something like an overnight fund, where on average you will probably be in the vicinity of, let's assume, 5%. The bond at the 4-year, 5-year government bond that you are foregoing by waiting is yielding roughly around 7.25%. So that is 7.25 minus 5, 2.25% for a full year. So if you are waiting, so that is actually 2.25 rupees for a full year if you were to wait the full year. Suppose you waited 6 months. So half of that, which is roughly around 1 rupee 10 paisa or thereabouts, is the buffer you have, which even if yields were to rise and this buffer were to evaporate, you would be indifferent between having invested today or having waited 6 months.
Okay.
So the cost of waiting, in other words, is quite high. You can run this simulation in other format. You can basically calculate the yield protection that this 1 rupee 10 paisa is roughly worth. And roughly it's worth around 25 basis points. So in other words, what this calculation means, and this is just a mathematical calculation, one can do it for oneself, that if today you decided not to invest in a 5-year bond and 6 months later you invested in the same bond 25 basis point higher than today, you are actually no better for having waited. So because the yield curve is steep, the cost of waiting is also large. Now, our view is that although for the near term, we are in a very volatile environment, but a lot of the yield repricing seems to be behind us. And therefore, even though markets will continue to be volatile for some time, today you have to very seriously measure the cost of waiting against the volatility. And especially if you have a 2-year plus horizon, which is only when you should be looking at 5-year, etc., then to us, it does not make too much sense to be prolonging allocation for too long.
So yes, looking at the reaction the bond market showed on the RBI policy day, as you mentioned that they reacted negatively, can we say that all the significant rate hikes are already being discounted by the markets in advance?
Well, you can tentatively make that argument, and especially in light of the latest data point on domestic CPI that we saw, which was a bit of a relief, where CPI actually came largely in line with market expectation and against market expectation of some people expecting an overshoot. That did not happen. So you could tentatively forward that hypothesis, but you should still budget for some shocks to this. As an example, the US market was beginning to stabilize on rate hike expectations, but one bad CPI reading led to a significant reset in that market. Now, we don't expect that order of volatility in India. However, it's prudent to budget for some volatility till at least the developed market rate hikes expectation cycle calms down. Having said that, we do expect the bulk of the yield reset, especially in the 4-5-year Government of India bond segment, is behind us. That does not mean that there won't be more volatility, but it means that if you do have a 2-year plus investment horizon, now is the time, in our view, to start to seriously look at these investments.
So what, according to you, are the key risks that a fixed income investor should be aware of today?
So the number one probable risk, which is probably getting underplayed today in fixed income, is the price for liquidity. So we see a lot of money moving into corporate bond oriented products in the 5-year segment at hardly any corporate bond spread. So wafer thin corporate bond spreads of 20-25 basis point over government bonds, people have been happy to allocate to corporate bond or SDL oriented products. Now bear in mind, this 25 basis point of spread that you are buying a corporate bond at over a government bond, or for that matter, even buying a state loan over a government bond, partly also reflects the price for liquidity, because even state development loans, although as per RBI, they don't carry credit risk, but they are nowhere as liquid as government bonds. So you may have a longer investment horizon, but you are buying into those bonds at hardly 20-25 basis point over underlying government bond, which means in our view that you are probably assigning a very low price for liquidity. So one of our clear views in this phase also is that although our preferred segment is 4-5-year, we would want and like to express that preference through just Government of India bonds in the 4-5-year sector. I reiterate, spreads on corporate bonds or state development loans in the 5-year sector are too low. And even though your investments could be for 2-year, 3-year plus, other investors will be moving in and out. And it is prudent not to pay too small a price for the illiquidity that comes with SDLs and corporate bonds. So that is the only observation that I would make in that way. The one other aspect you could think about is, although a lot of balance sheets in the system have cleaned up substantially, credit spreads on even lower rated assets have fallen very, very sharply. So the other thing that investors need to think about is, don't just evaluate the narrative that balance sheets have cleaned up, but also evaluate whether credit funds or credit-oriented products are available at the right pricing anymore or not.
Okay. So what would be your suggested strategy for a fixed income investor?
Well, like I said, we think the clearest value is in 4 or 5 year government bonds. In fact, even compared to other savings products in the system, this is one of those rare times that actually a 5-year government bond yield is amongst the most competitive when you compare it with other savings products in the system as well. Mm-hmm. Right? So we like strategies around that. Now, one way to do that is through gilt index products. But bear in mind also one risk of excessive allocation to index products is that they are roll down products, and therefore 5 years from now, you are subject to reinvestment risk. Put another way, this means that when your money is maturing 5 years from now, you don't know what part of a rate cycle you would be at. And suppose you are at the low point of a rate cycle, then you would find it difficult to reinvest that money, which is what I mean by reinvestment risk. So therefore, we think while gilt-oriented index products should be a core part of one's asset allocation today, one should also supplement that with high-quality open-ended funds, which are largely anchoring around this space, which is the 4-year, 5-year space. Obviously, the allocation would depend upon the kind of risk appetite and investment horizon you have. So it could be done through, short-term funds or medium-term funds, etc. But bear in mind also that the name or the nomenclature of the scheme or fund does not matter. You have to be very clear what is the portfolio strategy being followed under that scheme name, and whether that portfolio strategy is what you're aligning with. So in our view, this segment of government bonds makes the most sense. And as of last disclosed portfolios, therefore, we were overweight 4-year, 5-year government bonds or 4-year government bonds in, for example, our short-term, medium-term products also. But that is as of last disclosed portfolios.
Thank you, Suyash, for your insight on how one should approach the bond market and the debt market in current market scenario. Thank you so much for your time.
Thank you so much. Pleasure being here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.